You checked your bank account and the number didn't make sense. Not because you'd done something obviously reckless, not because of a single large purchase you regret. You paid your bills, you went to work, you didn't buy anything that felt extravagant in the moment, and yet somehow, with somewhere between 1 and 3 weeks still left in the month, the account is nearly empty, and you genuinely cannot reconstruct exactly where the money went. This experience has a name. It's called a leaking budget, and it is not the result of earning too little, spending too recklessly, or lacking financial discipline in any obvious way. It is the result of a specific set of patterns, invisible by design, individually small, collectively devastating, that drain paychecks systematically without ever producing a single moment of obvious financial irresponsibility. The frustrating thing about a leaking budget is that it doesn't feel like overspending while it's happening. Each individual transaction feels reasonable. The coffee was a few dollars, the subscription renewed automatically, the convenience purchase saved time, the dinner out was a social occasion, not a splurge, the online order was something you actually needed, mostly. None of it felt like the moment the money disappeared, and yet, at the end of the month, it is gone. Understanding why requires looking at the patterns rather than the individual transactions. Money doesn't disappear, it follows paths. Some of those paths are intentional. Bills you chose, purchases you planned, expenses you evaluated and decided were worth the cost. And some of those paths formed without your active participation, habits that automated themselves, defaults that never got questioned, spending that happens in the background while you're focused on everything else. The second category is where paychecks go. This video names 10 specific reasons your paycheck disappears before the month ends. Not generic advice to spend less or save more, specific mechanisms, named precisely, with the math that explains why each one costs more than it appears to and what changes when each one gets fixed. Reason 1. You have no spending plan, so spending fills all available space. This is the foundational reason that makes all the others possible. Without a predetermined destination for each dollar of income, money defaults to the path of least resistance, which is always toward immediate consumption. Spending expands automatically to fill whatever financial space is available. This is not a character flaw. It is a documented behavioral economic principle called Parkinson's law of money. Expenses rise to meet income. The experience of not having a spending plan is not the experience of making obviously bad decisions. It is the experience of making hundreds of small decisions daily without a reference point for whether any individual decision is consistent with a larger financial goal. Each decision feels reasonable in isolation. The aggregate result is a month where the money is gone, and no single transaction fully explains why. According to the National Foundation for Credit Counseling, only 41% of American adults maintain a budget. Of the 59% who don't, the most common reason given is that they don't feel they spend enough to need one, a belief that is contradicted by the consistent experience of not having enough money at month end. The math is straightforward. Someone earning $5,000 monthly after tax who spends without a plan saves on average 3.5% of income, according to Bureau of Economic Analysis data, approximately $175 monthly. The same person with a written spending plan allocating specific amounts to specific categories saves an average of 12 to 18%, $600 to $900 monthly. Same income, dramatically different outcome. The plan is not restricting the spending, it is redirecting it from unconscious to intentional. The fix does not require a complex spreadsheet or a financial advisor. It requires one decision made at the beginning of each month. How much goes to fixed expenses? How much goes to variable necessities? How much goes to savings and investments, and how much is available for discretionary spending? Once those allocations are made, every spending decision has a reference point. The money stops disappearing because it has somewhere to go before it arrives. Reason 2. Subscription creep has made itself invisible. There is money leaving your account every single month for services you either don't use, barely use, or forgot you were paying for. This is not speculation. According to research from Waterstone Management Group, the average person underestimates their monthly subscription spending by 197%. The average American believes they spend $86 monthly on subscriptions. The actual average is $219. The gap between perceived and actual subscription spending exists because subscriptions were designed to be invisible. Small amounts, automatic charges, distributed across multiple billing dates so no single statement shows the full picture. The $9.99 charge on the 3rd, the $14.99 on the 11th, the $7.99 on the 17th, the $12.99 on the 23rd. Each one registers as a minor line item in a month of transactions. The aggregate is a significant monthly expense that most people have never actually added up. The specific categories most responsible for subscription creep are streaming services, fitness and wellness apps, software subscriptions, meal planning and delivery subscriptions, news and content subscriptions, cloud storage tiers, and gaming services. Most households have at least one active subscription in each category. Many have several. The annual cost of average subscription spending is $2,628. Most people would describe that as a significant amount of money. Almost nobody experiences it as a significant amount because it arrives in $9.99 increments that never trigger the alarm a single $2,628 charge would produce. The fix requires one thing: a complete subscription audit. Pull up the last 3 months of bank and credit card statements, identify every recurring charge. For each one, ask whether you used it enough in the past 30 days to justify the upcoming charge. Cancel everything where the answer is no. The average household that completes this audit cancels $60 to $120 in monthly subscriptions, $720 to $1,440 annually recovered from spending that was happening entirely without conscious participation. Reason 3. You're paying the minimum on debt while interest compounds against you. This reason is different from the others on this list because it doesn't feel like spending. The minimum payment is made, the obligation is met, the account stays current. From a monthly budget perspective, the debt feels managed. What is not visible is what happens in the background while the minimum payment is being made. The average American household carrying a credit card balance owes approximately $6,380 at an average interest rate of 24.37%, according to Federal Reserve and Experian 2024 data. The average minimum payment on that balance is approximately $127 monthly. Making only the minimum payment, that $6,380 balance takes approximately 8 years to pay off and costs $4,200 in interest, meaning the total cost of the original balance is $10,580. But the monthly budget impact is more immediate than the long-term interest cost. Someone carrying $6,380 in credit card debt at 24% is paying approximately $130 monthly in pure interest, money that reduces the balance by zero, builds no equity, produces no asset, and delivers no value whatsoever. It is a monthly extraction of $130 that will continue indefinitely as long as the balance exists. Across all debt categories, credit cards, personal loans, buy now, pay later balances, the average household making minimum payments spends $200 to $400 monthly on interest charges alone. That is $2,400 to $4,800 annually paid to lenders for the privilege of maintaining balances that, from a monthly budget perspective, never seem to shrink. The fix requires reframing debt payments from minimum obligations to aggressive targets. The debt avalanche method, directing every available dollar beyond minimums to the highest interest debt first, eliminates balances in the shortest time and at the lowest total cost. Each debt eliminated permanently removes its minimum payment from the monthly budget and redirects it toward the next target. The monthly cash flow improvement compounds as balances disappear. Reason 4. Your fixed expenses have never been audited or negotiated. Fixed expenses feel immovable. The rent is what it is. The insurance bill arrives for the same amount every month. The phone plan was set up years ago. The internet package was the standard option at the time of installation. These numbers appear on the budget as constants, expenses that cannot be reduced without a dramatic lifestyle change, so they never get questioned. This assumption is incorrect for most fixed expense categories, and the financial cost of treating negotiable expenses as fixed is substantial. Insurance premiums are among the most negotiable recurring expenses most people never negotiate. The average household that calls their auto insurance provider annually, requests a rate review, and indicates they are considering competitive quotes, receives a discount in approximately 70% of cases, according to Consumer Reports research. The average discount is $200 to $400 annually. The phone call takes 15 minutes. The hourly rate of that call, in dollar terms, is somewhere between $800 and $1,600. Phone plans represent another category where the original plan selected years ago frequently costs significantly more than currently available alternatives. The telecommunications industry relies on customer inertia, the tendency to keep the same plan indefinitely, rather than periodically evaluating whether better options exist. Someone on a $90 monthly phone plan who hasn't compared alternatives in 3 years is likely paying $20 to $40 more monthly than necessary. That's $240 to $480 annually for the same service at a lower price available from the same or competing provider. Internet, streaming bundles, gym memberships, and subscription software all fall into the same category of expenses that feel fixed but respond to active management. An annual audit of every recurring expense, calling providers, comparing alternatives, and requesting retention offers consistently recovers $100 to $300 monthly for households that have never done it before. The fix is a calendar reminder. Once per year, a dedicated afternoon to audit every fixed expense, call every provider, and compare every recurring cost against currently available alternatives. The time investment is minimal. The financial recovery is among the highest hourly returns available in personal finance. Reason 5. Eating and drinking is costing significantly more than you think. Food spending is the budget category most consistently underestimated by the people responsible for it. This is not because people lie to themselves about food spending. It is because food spending is distributed across so many small transactions: grocery runs, coffee stops, lunch purchases, dinner deliveries, weekend dining, convenience store visits, workplace vending machines, that no single transaction feels significant, and the aggregate is never mentally assembled. The average American household spends approximately $9,400 annually on food, according to Bureau of Labor Statistics 2024 consumer expenditure data. For a household of 2, that is approximately $783 monthly, a number that would alarm most couples if they saw it written as a single monthly line item. Because it arrives in $4 coffee increments and $22 delivery orders and $140 grocery runs and $65 restaurant dinners, it never produces that alarm. The breakdown within that $783 reveals where the specific losses occur. Approximately 40% of household food spending goes to food away from home: restaurants, delivery, fast food, workplace food purchases. That 40% represents approximately $313 monthly spent on food that costs 2 to 4 times more per meal than the equivalent prepared at home. Delivery apps add a 25 to 100% markup on top of already elevated restaurant prices. A $15 restaurant meal becomes a $22 to $28 delivery order. The convenience premium compounds across dozens of monthly transactions. Food waste multiplies the problem. The average American household throws away approximately $1,500 annually in food, according to USDA research. Produce that wilted, leftovers that weren't eaten, ingredients purchased for a recipe made once. That is money spent and discarded literally, purchases that generated no nutrition, no enjoyment, and no value of any kind. The fix does not require eliminating restaurants or enjoying food less. It requires knowing the actual monthly food number, pulling 3 months of statements and adding every food-related transaction, and then making deliberate decisions about where within that number the spending should go. Most households find $150 to $250 in monthly food spending that can be redirected without any meaningful reduction in eating quality or enjoyment. Reason 6. Impulse purchases are happening faster than willpower can respond. The average person makes approximately 35,000 decisions per day, according to research from Cornell University. Financial decisions are a subset of that total, and the human brain is not equipped to apply careful deliberation to every one of them. Decision fatigue, the documented decline in decision quality as the number of decisions made increases, means that purchasing decisions made later in a shopping session, later in a day, or at times of stress or low energy are systematically worse than purchases made with full deliberative capacity. Modern retail, both physical and digital, is engineered to capture purchases at the exact moments when deliberation is lowest. Online retail, in particular, has systematically removed every friction point between impulse and transaction. Saved payment information, one-click ordering, app notifications timed for evening hours when decision fatigue peaks, personalized product recommendations based on browsing behavior, countdown timers and low stock warnings that manufacture urgency. Every obstacle between the impulse and the purchase has been deliberately eliminated because friction is the consumer's primary defense against spending they didn't intend to make. According to research from Slick Deals, the average American makes approximately $314 in impulse purchases monthly, $3,768 annually on items not on any list, not planned in advance, and frequently not fully wanted after the transaction was complete. Buyer's remorse rates for impulse purchases run significantly higher than for planned purchases, suggesting that a substantial portion of impulse spending produces regret rather than satisfaction. The fix is structural rather than willpower dependent. A 24-hour rule for any non-essential purchase over $30. Add it to a list, wait 1 day, then evaluate whether the desire persists. Research consistently shows that 24 to 48 hours of waiting eliminates the majority of impulse purchasing motivation, not because the item becomes less appealing, but because the momentary impulse that drove the initial desire dissipates without the urgency that retail environments manufacture around it. Removing shopping apps from the phone home screen creates additional friction. Deleting saved payment information from retail websites reintroduces the deliberation that one-click ordering was designed to eliminate. Reason 7. ATM fees, bank fees, and avoidable financial charges are quietly stacking. This reason operates entirely below conscious awareness for most people. The individual amounts are small enough that they register as trivial, even when they're noticed, and they're frequently not noticed at all because they appear as minor line items buried in statements dominated by larger transactions. ATM fees average $4.73 per transaction, according to Bankrate's 2024 checking account survey. A combination of the out-of-network ATM fee and the fee charged by the account holder's bank for using a non-network machine. Someone using an out-of-network ATM twice weekly pays approximately $492 annually in fees for accessing their own money. The fee is paid so automatically and immediately that it rarely produces any conscious financial decision. It just happens. Bank maintenance fees on checking and savings accounts that don't meet minimum balance requirements average $15.48 monthly, according to Bankrate's 2024 checking account survey. A combination of out-of-network ATM fee and the fee charged by the account holder's bank for using a non-network machine. Someone using an out-of-network ATM twice weekly pays approximately $492 annually in fees for accessing their own money. The fee is paid so automatically and immediately that it rarely produces any conscious financial decision. It just happens. Bank maintenance fees on checking and savings accounts that don't meet minimum balance requirements average $15.48 monthly, according to Bankrate's 2024 checking account survey. $185 annually for the privilege of holding an account at an institution that is simultaneously lending out the deposits at significantly higher rates. Online banks and credit unions offer equivalent or superior accounts with zero maintenance fees. Yet millions of people pay monthly fees on accounts they've held for years without questioning the cost. Credit card late fees average $32 per occurrence and are assessed automatically when payment arrives even 1 day past due. A household that pays late 3 times annually, not through negligence, just through the friction of manual payment management, pays $96 in fees that automatic minimum payment scheduling would eliminate entirely. Add overdraft fees, foreign transaction fees on cards used internationally, paper statement fees, and wire transfer fees, and the total annual fee burden for a household that has never optimized this category reaches $600 to $1,000. Not for services, not for products, for the absence of 20 minutes spent switching to fee-free accounts and setting up automatic payments. The fix is a one-time optimization that pays back permanently. Switch to a high-yield savings account and fee-free checking account at an online bank or credit union. Set up automatic payments on all credit cards. Identify in-network ATM locations near frequent travel routes. The optimization takes one afternoon and eliminates the fee category entirely from most households. Reason 8. You're funding other people's financial goals through your purchases. This reason requires a slight reframe to understand fully. Every purchase made on credit rather than cash has a hidden participant, the lender. Every purchase made through a platform with commission fees has a hidden participant, the platform. Every insurance policy, every subscription, every financed product is a financial relationship in which another party has engineered a profit margin into the transaction, a margin funded entirely by the buyer. The specific mechanism that drains paychecks invisibly is the credit card revolving balance. Someone who carries a balance and continues using the card for new purchases is simultaneously paying interest on old purchases while adding new ones. The card feels like a spending tool. It is functioning as a loan with a 24% interest rate that compounds monthly on a balance that grows with every transaction. Buy now, pay later platforms extend this dynamic to smaller purchases. A $150 purchase split into 4 installments feels like $37.50. It is $150, plus potential late fees, plus the behavioral research showing that BNPL users spend 10 to 40% more than they would paying up front, because the installment framing reduces the perceived cost at the moment of decision. The average household that primarily uses credit for discretionary spending, restaurants, entertainment, clothing, convenience purchases, and carries a balance month to month, is paying 20 to 30% more for those purchases in effective total cost once interest is included. A $400 monthly discretionary spending category carried on a revolving balance at 24% costs $480 to $520 in effective annual terms. The premium is invisible because it appears as an interest charge on the statement rather than as a price increase on the individual item. The fix is paying the full statement balance every month without exception, not the minimum, the full balance. This single behavior converts the credit card from a wealth extraction tool into a zero-cost payment convenience, and, in cards with rewards programs, into a minor wealth-building tool. The credit card is not the problem. The revolving balance is the problem. Reason 9. Lifestyle maintenance costs more than the original lifestyle decision. Every lifestyle upgrade has a maintenance cost that rarely gets fully calculated at the point of the original decision. The upgrade is evaluated against its immediate appeal. The ongoing cost of maintaining it is discovered gradually and absorbed without ever being formally budgeted. The vehicle is the clearest example. The decision to buy a newer, more expensive car is evaluated against the monthly payment and the appeal of the upgrade. The maintenance cost differential, premium gas versus regular, higher insurance premiums on a more expensive vehicle, more expensive parts when repairs are needed, higher registration fees in states that calculate registration on vehicle value, rarely get calculated at the point of purchase. According to AAA's 2024 Your Driving Costs study, the difference in total annual ownership cost between a small economy vehicle and a medium SUV is approximately $4,200. The monthly payment difference between specific models might be $150. The total cost differential is $350 monthly, more than double what the payment comparison suggested. The home upgrade version works similarly. Moving from a $1,500 monthly apartment to a $2,100 monthly apartment adds $600 to the obvious monthly cost. It also increases utility costs, renters' insurance premiums, and creates a higher baseline for furnishing and maintaining the larger space. The effective monthly cost increase frequently reaches $800 to $1,000 when all maintenance costs are included, significantly more than the rent difference suggested. Clothing and appearance maintenance costs follow the same pattern. A wardrobe upgrade to higher quality or more fashion-forward clothing increases dry cleaning costs, creates ongoing pressure to maintain the wardrobe standard, and establishes a higher replacement cost when items wear out. The original purchase decision didn't budget for these downstream costs because they weren't visible yet. The fix is calculating the full cost of ownership for any significant lifestyle decision before making it, not just the obvious monthly expense, but every ancillary cost that the lifestyle level creates. The question is not whether the upgrade is affordable. The question is whether the complete ongoing cost of maintaining it is affordable, including every expense category that changes as a result of the original decision. Reason 10. You don't know your actual monthly numbers. This final reason is the one that makes all the others possible. Every drain on the list above operates most effectively in the dark. Subscription creep is invisible when the total isn't known. Impulse purchases feel minor when they're never aggregated. Food spending feels reasonable when the monthly total is never calculated. Fee extraction continues indefinitely when no one is looking at it. The foundational financial skill that prevents paycheck disappearance is knowing the actual numbers, not approximately, not generally, but specifically. What comes in, what goes out, where it goes, what each category actually costs. The gap between what most people believe they spend in each category and what they actually spend is consistently significant across every study that has measured it. According to research from Intuit, the average American is wrong about their monthly spending by approximately $1,100 per month. They believe they spend $1,100 less monthly than their actual expenditure. That $1,100 gap, multiplied across 12 months, is $13,200 annually in spending that is happening without awareness, and therefore without any active decision-making about whether it should continue. The fix requires one action: a complete spending audit for the last 3 months. Every transaction across every account, categorized, totaled, and compared against what you believed you were spending. Most people who complete this audit experience a version of the same response: surprise at 1 or 2 categories that are dramatically higher than expected, recognition of subscriptions and fees they had forgotten about, and a clear picture of where the money has actually been going. Once the actual numbers are known, the paycheck stops disappearing. Not because spending becomes perfect, but because spending becomes visible. Visible spending gets managed. Invisible spending grows unchecked. The audit is the intervention that makes every other fix on this list possible. The 10 reasons on this list share a structural characteristic. None of them require a dramatic financial failure to operate. None of them require reckless behavior or financial irresponsibility. They work on careful people. They work on people who consider themselves financially responsible. They work precisely because they are invisible at the individual transaction level while being significant at the aggregate monthly level. A spending plan eliminates the space that invisible spending fills. A subscription audit recovers $60 to $120 monthly from charges happening without awareness. Aggressive debt repayment stops the interest extraction that drains cash flow permanently. Fixed expense negotiation recovers $100 to $300 monthly from expenses treated as immovable constants. Food spending awareness redirects $150 to $250 monthly from unconscious to intentional. The 24-hour rule eliminates the majority of the $314 monthly impulse purchasing average. Fee elimination recovers $50 to $80 monthly from charges paid for nothing. Paying full statement balances stops the 20 to 30% interest premium on discretionary spending. Full cost of ownership calculation prevents lifestyle upgrades from creating hidden ongoing expenses, and knowing the actual numbers makes all of the above possible. The paycheck is not disappearing. It is following paths that formed without your active participation and have never been redirected. The paths are visible now. Every one of them leads somewhere specific, and every one of them can be changed. The money you earn this month will follow one set of paths or another. The only difference between the version of this month where the balance makes sense at the end and the version where it doesn't is knowing which paths exist and deciding deliberately which ones your money should travel. That decision starts with pulling up the last 3 months of statements and adding up the actual numbers.
Everything else follows from there. If you're still here watching, thank you. It really means a lot. Before you go, tap subscribe, and if this video helped in any way, give it a quick like. Can't wait to see you in the next one. Love you guys.